I'll let you know that I have had an unscheduled meeting that I have been summoned to downtown at 4 o'clock. Hence, sorry, Jim Russell, it was not you that got the tie out today, but so I will start out here with you on Zoom, and then I'm going to move to my cell phone and get downtown and continue that way. But I very much appreciate all of you guys joining us on Zoom. Meeting has been, so are we online, live?
Yes.
We are live. Okay. Well, to not prolong, I will call our meeting of the Cincinnati Park Board Investment Committee to order. And we'll note for the minutes that we have all of our members present. I will first say to everyone, I still would like to add to our committee. So I am going to make it a push on my part to try and once again get back and identify potential members to join our committee. We're not limited to a certain number. So if any of you can think of people that might be interested and willing to participate with us, let me know, and we will pursue them vigorously. With that, our first, yes, Kevin.
With that thought in mind, a name just popped, and then it popped right back out. Tim Johnson. Tim is, for the most part, retired now. He started Johnson Investments. He still lives in College Hill. So he's a city resident. Should have some time on his hands. And I served on the board with him at the Drake Center years ago. He was very astute at getting past the bullshit and getting down to the real numbers. So
I will follow up with him. I'll have to call him out. I'll slip and call him professor. When I was finishing my MBA at UC, he was one of my instructors. So I will follow up with him. I'll also say that I will push as well for diversity on our committee. So he's an excellent recommendation. And like I said, we're not tied to a certain number. So we'll pursue.
And I will also reach out to Eric Kearney and see if he can find a person or two of color that might be interested.
That would be great. I've contacted him a couple times about it and have not gotten names back, but perhaps
I'll twist his arm.
Thank you. Okay, well, with that, we'll get started with our agenda, and I'm really glad to have Jim Russell with us. Jim, what we are doing is throughout the year, we have called in our fund managers to do a presentation. So I want to thank you for your work with our funds. We have been very complimentary. We know we've had up and down markets and a little bit of a hiccup. Is that what you're calling 2021, or I mean 2020 with COVID, et cetera? But we'll turn it over to you, and we've received in advance your full presentation. So if you want to focus on highlights, we would appreciate that. But Jim, I'm going to turn it over to you. And as I said earlier, if you've missed my face, I will still be connected via voice. So Jim, I'll turn it over to you.
Yeah, that sounds good. Thank you for your time and attention right up front. We will be going through the deck. Please stop me with any question on anything I say, or frankly, things on your mind. We can absolutely go off script here a bit on anything that you feel is relevant or important for the committee. And so, anything is fair.
Hello, Patricia. Do you mind muting your line? Thank
Craig,
you.
are we in good shape, Craig?
I think we're good now. Thanks, Jim.
Okay. So is someone flipping the slides? Because I submitted them And Craig, I'm assuming that maybe you would drive and share your screen.
Traditionally, when we do it through Zoom, we just go through the information versus presenting them via over the web, because this is live. So a lot of times
Okay.
we just go through each of the pages, and each of the committee members does have the packet.
Okay, so I think that, thank you for that guidance. I'm going to start on page 2. I think for any type of funding mechanism where a organization is attached to certain streams of income, it's important to understand what the income that is generated, the withdrawals on an annual basis, the management fees, of course, which are displayed there, and then the net. You can see that our 2021 numbers are year to date. We do not have a complete data set there. It looks like we've been running maybe in the $30,000 range on an annual basis, and about, let's just say approximately 1/3 of that's been taken through 9/30/21. So this is a strategy that is a income generating strategy via the dividend. We'll be speaking at length about that later in the deck. So you can kind of see that the strategy is not completely dependent upon the market going up in order to meet the needs of the Parks Board and the mission that, of course, that we support financially here.
You know,
On
Jim,
page-
this was an eye opener for me. We have not
Okay.
seen this type of presentation. I really like it though. I mean, it really does show us on a cash basis the impact of our draws. And it also made me realize that when we look at things, we're looking at total return and including the growth in the assets, the asset valuation itself. So this has been a good look for us from a cash basis. And I would just ask you, is there anything about this that is alarming to you as it relates to other clients that you might have when you see that over time we've dropped 131 from a cash standpoint? Does that seem reasonable to you?
It does seem reasonable, Jim. On an annual basis, I think that the draws of, call it again, around $30,000 on a kind of a all-in basis has been, again, supported by very favorable market conditions. We won't always have that. I think you mentioned in your opening remarks that 2020 was tricky, even though it was down then up for the entire year. And you can see, by the way, that the income from the dividend stream really top-ticked it at $86,000 that year. Wouldn't be at all surprised if we're going to be around that number or even exceed it on a full year basis for 2021. But as everyone on this committee understands, if you persistently, in a dramatic fashion, withdraw and chip away at the principal, then the principal, of course, cannot generate the income, and you're in a bit of a downward spiral. So I think everybody understands how that dynamic works a little bit. So far, again, the markets have been generous on an annual basis and provided exactly what we need in terms of, I'd say, a modest draw into principal on an annual basis. And of course, the markets have been able to make that up. Alarming, no. Concerning, no. It'd be wonderful if the fund were just a little bigger, so that we could maybe get in $100,000 or something that would almost match or exceed the annual withdrawals on a annual basis. So we're not there. So we continue just to do what we can in terms of just the income flow on an annual basis. One other thing I might suggest is that inflation is starting to maybe move up a little bit. Can't help but wonder if your costs are also, maybe contractually locked in, perhaps to some extent, but maybe on the move a little bit higher. We have generated, and you'll see this in a later slide, Jim, a 10% increase in the year-over-year dividend. And so that is it too, an inflation fighting type of income stream increase.
That's great.
And then maybe those higher costs covered with that type of cadence.
Jim, just so you know, you're freezing up.
Yeah, and I saw that on your side as well. Did you lose the audio?
No, we've got it. Thank you.
Okay. Okay. I may, if you don't mind, I may turn the video off just so that that doesn't happen again. But we'll continue through the deck, and if the audio does become a little bit less than reliable, please let me know. We'll go ahead. If there are no other questions, we'll maybe flip to slide 3. And this is a little bit of a visual display. We call this a PSN chart. And this measures both risk and return. We think this is important because returns, yes, they're important to an organization, but how much risk are you taking to get there? So you can see the 80-20 benchmark right there in the bullseye. And you can see that essentially we're in line with that benchmark, slightly below gross and slightly below net. And so, of course, the difference between gross and net is the raw return, and then the raw return minus the fee in the case of the net results. You can see, though, as measured by the standard deviation on the x-axis, we are taking less risk to get to the returns that we're providing, which, again, are benchmark competitive. You can see the rate of return at the bottom of the chart there. We're right on top of the benchmark, 894, 831, and then the benchmark at 896. The standard deviation a bit lower than the benchmark, so we're not taking benchmark-like risk. We call this an attractive risk-reward type relationship. Sharp ratio, if higher is better, and that is a measure of risk-adjusted return. Beta, of course, is volatility. You want less volatility, lower is better. The markets, or the benchmark rather, would represent a beta of 1. So we have less volatility than our benchmark. Alpha is excess return, and downside capture means that when the market goes down 1%, we would be down 86 basis points roughly. So that's kind of how the statistics read. We are taking less risk than the benchmark and essentially in line with the benchmark in terms of return. But let me pause there to see if there are any questions, any thoughts, any comments on anything I've covered so far.
Questions here. Thank you.
Okay. If not, we'll turn to page 4, a little bit more detail. We're going to maybe dig into what types of equities actually, generate the lion's share of the performance. You can see in the upper left-hand corner our top 10 security holdings here. Most of these are household names to most folks, I think. Microsoft, JP Morgan, Marsh & McLennan, et cetera. You can see the market value, the portfolio percentages in terms of the participation. By the way, we begin to sell security when it reaches about 5% of the portfolio value. So we do believe that diversification matters. We use it as a risk mitigation technique. And you can see that, again, our largest position is 3.7%. The asset allocation is a little bit heavy on the equities. I will probably take the fourth quarter to rebalance just a little bit, maybe down to kind of an 80-20 type of mix. We literally today received a notification that one of the bonds will be redeemed or called. It's going to be an American Express bond, $50,000. So we will end up reinvesting that in the fixed income markets. And then also we will trim proportionally up and down the portfolio and raise a little bit of cash. And again, get the fixed income percentages kind of closer to 20% and maybe bring the equity percentage down closer to 80%. as we move forward. So you can see the cash and equivalents, the fixed income and equities at the bottom, a 9/30 market value of $4,065,000. I looked this morning, as of today's open, the portfolio value is $4,312,000. So we've made a little bit of headway here in the month of October to date, as the equity markets continue to be, for the most part, on the positive sides. You can see on the bottom left-hand corner, we are predominantly large cap stocks. We've got a couple of mid-cap type names in the portfolio, but candidly, they don't have meaningful weighting to appear in the top 10 or really in the middle, in the next 10 either as well. So any thoughts there? If not, we'll turn to page 5. I mentioned earlier in the program that we would be talking a little bit about dividends. There's probably a couple of things that are certainties in life: death, taxes, and when you talk to Ball and Gaynor, you're gonna hear the word dividend. So you can see the top 10 dividend increases for the relationship in the big box front and center here. These are pretty strong dividend increases over the last 12 months. Now, of course, we've had 3 months of 2021, and of course, this would also include the fourth quarter of 2020 as well. You can see that the median dividend increase in the bottom box was 10%. I think that's a more representative figure, candidly, than the average. And all of our stocks that we own, all 54 of them, pay a dividend. So we do think this is a meaningful way to meet the obligations of the Parks Board, as well as, again, once the markets do turn volatile and down, this provides good downside protection to the portfolio. And that type of downside volatility is always unpredictable. We do not make market calls, but it's inevitable that in the future we will hear and see additional volatility from the capital markets. It really has not been present since really the spring of 2020 and kind of the COVID period. Page 6 really gets into maybe some of the more granular performance data on a quarterly basis, specific to the third quarter of 21. The total account returned 54 basis points. The benchmark returned 49 basis points. So we were whopping 5 basis points ahead of the benchmark on a year-to-date basis. We're slightly behind the benchmark. Year-to-date, Ball and Gaynor has returned 12.01%. That would include the stocks and the bonds, so all in, and it's after fee. And then the benchmark at 12.44. The one-year numbers, 23.13 on the account, and then the benchmark at 23.47. So again, just to repeat just a little bit, we're around the benchmark with taking a little bit less risk. Of course, we do strive to beat the benchmark, and in the fourth quarter period of 21, we hope to continue to maybe move the account forward relative to the benchmark. So since inception, 831 versus a benchmark of 896. The next page really gets into
Jim, can I ask you a question too? We know your approach at Ball and Gaynor. You've talked a lot about your equity position and your strategy with equities, looking at primarily the large caps. When you approach your bond investments, what's your strategy? What do you look for there?
Yeah, great question, because that is 20% and a meaningful component of the income, as well as a meaningful component, excuse me, of the total return picture as well. Number one, first and foremost, Jim, we look at quality. We only invest in high grade fixed income securities. Given where the treasury rates are now, we tend to go in a direction of corporates as opposed to governments or agencies. Also, given what we think may happen, and that is we get a period of rising interest rates here. I think we'll probably be fairly short in terms of picking securities in terms of the maturity. Call it 3-4 years at the most, maybe 1 or 2 years if we find something attractive. As you were transitioning to your next appointment, we were talking a little bit about bringing the asset allocation maybe closer to an 80-20. Stocks have appreciated to the point where they're a little bit, maybe a little bit full in terms of where we would like them to be, and we will be spending the fourth quarter trimming securities proportionally and bringing the fixed income portion up to about a 20% weighting. Cash would be a residual, and of course we could raise cash at any time, usually from stocks, in order to meet funding needs as we're aware of them from Craig.
Yeah, I was still connected, so I did hear that. I fully agree with you, and I know with the movement of the equities right now, that makes sense. Taking another look at it. So, no, I thank you. That answers my question.
Yes, sir. Page 7 really gets into maybe some additional historical, display regarding performance. 2019, 20, and then the first 3 quarters of 2021 are all listed, as well as the since inception number. We've kind of covered a lot of this data in prior slides, but if there are any questions at all, please let me know. We do consider last year to be, let's just hope, a unique year, both for human beings in general, for society in general, and certainly for the capital markets as well. We are seeing it in our numbers every single day in our performance attribution, a normalization of the stock market. Now, in the second quarter, we did begin to see a little bit of maybe, let's just say, turn toward or back toward kind of the COVID days. We certainly saw the surge of the Delta variant here in the United States, globally as well. Certain countries, China specifically, are still struggling with outbreaks here. But we think by and large, we're in a position in the United States to probably live with this at this point and manage it correctly and maybe manage around it to an extent. We think economically, from an investment standpoint, and again, from a societal standpoint as well. So we feel that the market continues to normalize, and we are seeing that in our numbers in the fourth quarter, which are favorable in terms of kind of an early fourth quarter to date type of performance. Page 8 really speaks to the fees in detail. You can I break down in market value as well. You can see that all of our equity exposure, that's the $3.533 million, is in U.S. equities. We do not have any foreign securities. We do not anticipate adding any foreign securities. Sometimes that introduces dividend flows that are not paid in U.S. dollars. We do view that as just maybe more trouble than it's worth, and we have ample opportunity domestically to continue to source total return and higher dividend flows and income flows domestically. Fixed income comes in about $420,000. Cash, we usually try to keep anywhere from $75,000 to $100,000 plus in cash, again, for calls from the Parks Board and needs there. Any kind of visibility on your draws on this account would be appreciated in terms of, wow, in December we foresee $125,000 draw or a $50,000 draw, or in 2021 we foresee some heavy withdrawal activity. So to the extent that you can maybe forecast that or give me a heads up around your funding needs, that would indeed be appreciated and maybe help in terms of specific exposure to the capital markets and then timing on raising cash as well.
You know, Jim, we typically will only declare what our intent is for the calendar year once a year. So
Okay.
we can clearly, it's on a very, and in fact, we have not done that since I've been on the park board, that we took an additional draw from any of our equity funds. So we can clearly, and from your standpoint, just continue to think that you'll hear once a year from us our intent. So you should not be overly concerned that there will be an unexpected draw. We would know those types of things very early on to give you full time to react. Craig,
That sounds
I
good.
think you
Go
would
ahead.
agree with me, don't you, Craig?
Yes, I was going to add, traditionally, we do that annual draw, I believe, in August or September. But that's something we can communicate. I know this draw for this year was a little earlier due to market conditions, but absolutely, Jim, we can follow up with you and give you an idea of when we're going to take the draw.
That sounds great. And again, I think it would be work to a constructive benefit, a constructive end to cash management within the funds a little bit. Can I take then, Craig, from your comments that that $59,400 year to date 2021 is approximately 3/4 of the draw, or that be the full 2021 draw as you see it today?
That will be the full 2021 draw as of today.
Okay. And you do not anticipate a fourth quarter draw, and so we kind of move into 2022, and notification will be given when you're comfortable with the numbers.
That is
Yes,
correct.
I would anticipate, Jim, that you'll hear mid-year is typically when we will act as a board following Craig's budget workout with us. So yeah, you'll know, and it'll be typically you will know for the year what our anticipated draw will be at that time.
That sounds great. Thank you for that visibility and clarity on how that works. The next page.
Jim
Yes, sir.
Getz.
Hey, Kevin.
Hey, just a question. The ball and gainer funds are not subject to the 5%.
No, that Jim, the funds that we have with you are not considered a private foundation, so
Right.
we are not bound by the 5% ruling of the IRS.
In terms of a 5% or more withdrawal on an annual basis, kind of metric, right?
Yeah, the required minimum 5% withdrawal on an annual basis.
Right. Other
Does that answer
questions?
Kevin?
The next page really speaks to fees. The next page being page 8, just to be clear, management fees are running at 40 basis points. That is very typical of a fund this size with tentacles attached to a public entity. So I would tell you that that's a competitive fee. It's not high, it's not low. It's really kind of spot on, candidly. Custody fees are 2 basis points, so they total 42. The next pages really get into the detail of the specific holdings that would include the corporate bonds and adjustable rate preferreds, et cetera. Certainly the stocks as well. Let me pause here to see if there are any questions whatsoever on anything I've said or anything that is on your mind regarding this or the investment outlook or any other dynamic that you feel is important.
Hey, Jim, this is Steve. I think I've got an easy one for you. If you look at the portfolio appraisal pages, and I know that that's kind of a snapshot in time and not necessarily what the portfolio was through 9 months, but it would indicate that we're heading towards, annual income of close to $90,000, interest and dividends. And if you annualize what you showed on page 2, that kind of makes some sense. We're at 65K through September. last year, we had interest in dividends of about 90,000 again. We were at 86. The one thing I'm curious about, and I suppose it relates to the fixed income piece, but if all of these companies on page 5 have increased their dividend so dramatically in the last 12 months, why are we not higher in terms of annual income? And is it just because the yield on the bonds is so low?
I think that's part of it, Steve. I think another part of it is something that we touched on earlier in the discussion. Jim Getz brought this up, and that was that there is modest chip away of principal. If the principal were even, I think that a number in the, call it low 90s, 92, 93, 94 could maybe be expected. So we are swimming hard upstream a little bit as principal continues to be chipped away at in terms of income received, total withdrawals, management fees, and then of course the net. This year is going to be low in terms of the withdrawals relative, I think, to the income. So I think that, should withdrawals, let's just say annualize in the $10,000 or $11,000 range in terms of the negative, the lower the better in terms of chipping away at the principal. So as mentioned, it would be wonderful if the fund were a little bigger in that the total income received would be, 100K, 110K, something like that, more than meeting the withdrawals and of course the management fees. We're not quite there, but hopefully we can get there before too much longer with some persistent good work. So I think that the two items, and that is low fixed income yields, as well as some persistent chip away of principal as we, on an annual basis, I think combine to have for a modest increase in the total income received. I think your numbers are, of course, as they always are when they come out of Steve Pullman's mouth, accurate and insightful.
Yeah, I think it. The first page that Jim Getz was talking about, to have modest negative net flow on that page. I mean, that doesn't particularly give me a great deal of heartburn, because Jim, although we're dipping into appreciation, we're not really dipping into corpus in any way. I mean, we're spending, instead of living on interest and dividends, we're spending a little bit of market appreciation, and that's hardly a sin. I think that the key is, to your point, if interest in dividends could be 100 or 110, that would soften the blow. But right, to dip into market appreciation, as long as market appreciation is 12%, like it has been, that's okay.
Your point's very well taken. Where this becomes a little bit more problematic is if the market goes down for 2 or 3 years in a row.
Right.
And we have, and so the markets have again been pretty generous. Let me just kind of rattle off. The markets are a bit expensive, at least in our view. Earnings growth peaked in the second quarter of this year. Interest rates are on the rise. There's not going to be much in the way of fiscal stimulus this year. Inflation's higher. So those things really combine to really suggest that market returns looking forward are going to be perhaps more modest and perhaps even negative before too much longer. So your point's well taken. And so far, absolutely, it really hasn't caused a problem. And if we were to get a 2 or 3% decline or a 5% decline, it probably wouldn't be a problem next year either. Should we get that type of market action in 2022? We don't know. Yeah. But it's when the market goes down and stays down and continues to be volatile in a downward path where this let's just call it chipping away at appreciation or principal becomes a little bit more problematic. And I think you understand, again, mathematically how that works.
That makes sense.
Yes,
Jim,
sir.
I just took for granted it was 12.44 forever.
Bernie Madoff would tell you as such, but we don't play that game.
Yeah.
From your lips to God's ears, Mr. Pullman.
Yeah.
We'll book that one, Steve. That works for me as well.
Yep.
Yeah.
Jim Russell, I had a question, maybe a little bit wonky, but on benchmark, because I tend to focus pretty strongly on the benchmarks, and to the extent that the S&P is a benchmark, and I really look at the net of fees. I pay most attention to the net of fees numbers, and in a sense, having S&P, even though you could have a very, very, very low cost S&P index fund, that index is gross of fees. So you'd have, even if we're just a very low cost index fund, you should probably depress that by a few bips to compensate for that. Is that a fair way of looking at that?
That is a fair way of looking at that. I think that's an accurate assessment.
Thank you.
Yes, sir. Let me also mention one thing. It sounds like a lot of folks are pretty plugged into the capital markets here. And maybe over the last 3 or 4 years, and certainly in 2020, we got a big dose of this, that the S&P 500 is now very top heavy in about 5 names, 5 stocks. And these are, at this point, they're all household names. They're Facebook, Amazon, Apple, Netflix, and Google, commonly called FANG. 5 stocks in the S&P 500 make up 23% of the S&P 500 due to market cap, meaning that the other 495 stocks in this index make up approximately 78% or so, 77% or so. If you do not participate in those 5 stocks, you basically get left behind when those stocks are going up, of course. None of those stocks, with the exception of Apple, pay a dividend. We cannot participate in non-dividend paying stocks. So we've been able to really put up numbers, we think, that are fairly competitive with the S&P 500 without participating fully in really some key market drivers over the last 3 or 4 years. We do feel that because of some dynamics that are going on, number one, interest rates on the rise, and secondly, valuation of the FANG stocks, that perhaps FANG begins to go sideways or maybe even go down here a little bit. This is going to be a stock picker's market from here on out. And that is the indices will be easier to actually beat than they have been up until this point, meaning that a good stock selection, which is what we do, bottom-up stock selection, should work a bit better than it has in the past, especially for an organization that prides itself with producing dividend income. So just if we were to maybe fast forward a year or 2 from now, I would guess that our numbers look a bit even more competitive against the benchmark that we're looking at today. We'll have to see how that plays out. And absolutely, I'm not guaranteeing any investment results, but it does appear that some of those dynamics are at play and are changing a bit here just in the last, let's say, 3 or 4 months. They can snap back to the old way, but we think they're going to be fairly enduring and persistent. Other thoughts, other questions today?
If there's no other questions, Jim, I just want to reiterate that we appreciate the work that Ball & Gaynor does for us. You are a unique part of our portfolio, and appreciate your help in investing these funds. And I know Craig has said it's easy to work with Ball & Gaynor, and we appreciate the the administrative help that you have given us. So, Jim, I speak for myself, but I've been pleased, and we look forward to the relationship with Ball and Gaynor going forward.
Thank you very much for those nice comments, Jim. And certainly, if there are other items that we can see to on behalf of the Parks Board, let us know what those might be. In between quarters or in between meetings, let us know, and absolutely we'll be responsive in that regard. So just let us know what we can do to further the mission.
Craig, did you have anything else for Jim?
No, I just want to thank you, Jim, for presenting and providing the information to us, and I hope you have a great day.
Thank you for your time and attention again, and a great group of folks here. So again, let us know what we can do to move the ball down the field a little bit, and go Braves. That's all I have to say.
I second that one.
So far, so good.
So far, so good.
All right. Thank you so much, Jim.
Okay.
See you,
Thank
Jim.
you all. Have a great
Thank
day.
you.
Bye-bye.
Thank you. We'll continue with our agenda, and now that Jim's gone, is there any concerns that you'd like to raise? Anybody? I don't want to speak for you all, but I think it's a good piece of our total portfolio.
And I think Steve did point out a good indication there for total income received. It was interesting to where they did mention the dividend rate increases, but yet it wasn't noticeable on the actual slide number 2 with the increased income. But we do have another quarter. I'm curious if it does show October's dividend releases, or if it's obviously it doesn't show the middle of December's yet either. So it'll be interesting to see what this looks like at the end of the year.
Great.
It'll probably be better than the numbers that he said, because we probably don't have a lot of 930 interest in dividends. They probably show up on the October statement, and then we'll see how we accrue those at the end of the year. But you would think that we might be pacing a little bit faster. Maybe what the future is going to hold, though, is slightly higher interest on some of those bonds, and maybe a moderation of the dividends. And maybe we're always going to be in that 90 to 100K interest in dividend on this portfolio until it gets bigger. But, to dip into it the way we have it, remember, Jim, from the YMCA portfolio, if you can live on interest in dividends, and we basically are, that's pretty solid. That is pretty solid.
The only other comment that I would add is, and it really kind of hit home with this guy more because of the questions he was asking us, is, are there advantages rather than just taking X% from all of our different endowment funds? Are there advantages to be had depending on fees, et cetera, interest versus dividends versus, are there advantages to taking more out one year out of one fund and then the following year? I mean, it requires a level of sophistication that we haven't done up to this point. But if there's an advantage to be had, it might be something to look forward, on a looking forward basis. If we had done this, where would we be at the end of the day?
Kevin, that also provide an opportunity for sort of a natural consequence of performance. If we are rating on where you want to have your, and assuming that the funds are interchangeable, which they're not perfectly interchangeable, but for the sake of argument, say that they are, to the extent that you deplete, I use that in air quotes, to the extent that you deplete a lower performing or higher fee or whatever metric you want to choose, that's kind of a natural consequence of that. I think I don't know how you construct the model to do that, but it would be because we've talked, as we've listened to different presentations, about consequating, for lack of a less childish word, but is sort of consequating differential performance, and that would certainly do that. From a presentation perspective, and maybe it just speaks to my particular worldview, but I thought that I thought it was the right amount of detail and data. It was there if we wanted to. I would use that as a template for all of them, personally. I thought it was, it's not, if you want to hide a log, put it in the forest. No, there's no forest there. I thought it was good, a very useful, relevant presentation from at least my level of review.
Yeah, and I want to thank both of you. I mean, Kevin, that's a great point. And we'll commit that we will take a look at that this time going forward. It's an excellent comment and suggestion, and I think it's worth our time. And John, I agree with you. Steve's had a lot more time and experience with Jim Russell, but he has always been, in my mind, a bottom line guy, a straightforward guy, and I think the presentation that he gave us today is indicative of how he treats clients and just how he does business. So I agree with you, John. I found it to be pointed, to the point, and not a lot of window dressing there. So, well, good. Well, we'll move on in our agenda here, and I'm going to pop out of here very quickly, but I'll do the most important part and say, can I have a motion to approve minutes, or are there any adjustments to the minutes of their last meeting?
So moved to approve.
Seconded.
Okay, we've got a motion to approve in a second the minutes. All those in favor say aye. Aye.
Aye.
Any opposed? Okay, well, the minutes are approved. As far as the quarterly reports, Craig, you can walk us through there. The only comment I'll make is I didn't see any outliers or significant questions, but I'll apologize for having to step out of here into a meeting. But I appreciate you guys' time again today. And Craig, if you would take over, lead the rest of the discussion, and then pick the next meeting date, I'd appreciate it.
Well, thank you, and good luck in your meeting, and hopefully get some decisions down there. Is this for Lot 28?
This is actually for the new Gateway to Freedom Park.
Okay, well, that's great.
To be announced, I guess.
Mindful live on YouTube.
Yeah.
Oh yeah.
Oh, that's true. So to the thousands of people watching us, disregard that last comment, and I'll sign off here, and Craig, please continue. But thanks, guys.
Very good. Okay, we'll continue. Our one or two viewers will be able to listen to that comment and run with it. So we'll move on with the quarterly performance report. Did you all get to have a chance to review it? A couple items I do want to point out. I did reach out to PNC in regards of them not showing since inception date. So that's an item that'll be added in the future. We can start with the U.S. Bank. U.S. Bank overall, when you go through the actuals and the benchmark, they're fairly similar for their 3-month and year-to-date benchmarks. We went through Miles Edwards, and for PNC, you will notice that they were right on the 3-month benchmark. They're minus 0.2 of a basis point, and then their year-to-date. A reminder that is a customized benchmark. The first quarter, actually almost 2 quarters in 2021, they were managing through a different investment policy, and then they switched over. Or I believe it was the 3rd quarter to the investment policy that everybody, U.S. Bank and Fifth Third, are utilizing. As far as Fifth Third Bank, you'll notice they perform very similar to U.S. Bank and pretty close to their benchmarks as well. The only one that's kind of out there is that Levy Clock. That is a unique fund with the low dollar value that it does appear like its year-to-date numbers are significantly higher than the benchmark. Any questions?
I kind of have a question for all three of you guys, just as I think out loud here. When we talk about, maybe a strategy of spending more or less by these individual funds, although it would be great to not have to dip into the ball and gainer and just watch it grow and grow and grow. If we did decide to dip into these other two portfolios that are largely 65-35, right? So, there would it not be kind of a foregone conclusion that we would hurt those funds' ability to recover? Whereas when you're 80-20 with ball and gainer and you spend a little bit of appreciation, you have a chance to fight back. But if you start dipping into those funds that are more driven by corporate bonds, I don't know the answer to that question. I was just thinking aloud when we were talking about that strategy. I wonder if it would hurt to do a heck of a lot different than we're already doing. What, you know what I'm getting at, John?
Yeah, I guess I was stuck on more of the, we evaluate, but toward what end? And if we're looking to drive superior results, but I guess I look at it aggregated. I look at, we have responsibility for this 27, whatever that amount of money is. And so I would almost be more inclined to, if we did move in a direction and we felt like a recovery was, I'd be okay. And I don't know if this probably requires commissioner approval, but subsequently tweaking as part of that move, also tweaking IPS to allow for a greater degree of securities to accommodate that recovery intent. Or I think it would be well paired. If we're going to purposely draw more from one set of funds than another, again, to the degree we can, I like giving the stronger performing, the folks who are doing appreciably better than a benchmark, give them a little more latitude. They've performed, they've earned that kind of, I'm trying to avoid give them more rope, because what do you do with rope? But I want to give them, I think it's okay to give them rope if their performance has warranted, not radically. I'm not saying they go 95 in private equity funds. I'm just saying, could you go from 65 to 75? I don't think that's hanging out the windows crazy. I think that just gives them a little more latitude to, as you say, sort of recover should that, or rather when that day comes that a recovery is necessary, gives them the latitude to do that.
And I think we would have to look at these things differently than we've been looking at it, where we've been comparing all four money managers, really comparing against, playing them one against the other. It's almost like we had to do that exercise. We had to get through that exercise. But if we're through that exercise, now we can focus more on maximizing the return to the park board for useful money.
It's kind of like a growing company that we've initiated performance reviews now. So we've done that. We do that for a couple of years. Now, do we go to the level of top grading? Does that become sort of the next step in the process? And philosophically, I don't think that's mine to say, but if we want to, that would be drawing funds from, certainly we could just shift funds more quickly, but it would more gracefully and naturally draw funds from the things that aren't the top performers.
I think Craig visibly winced when Kevin suggested this might require an additional level of sophistication. But we just have to be careful, because if you spend more from those funds that aren't doing well, or spend more from those funds that are 65-35, they really don't have a chance to recover. It's kind of like unloading when the market is down, if you do that. So I think unless we do what you suggest, John, is you that is your strategy, but you inject more flexibility about the mix of these portfolios and give more leeway to the managers, because otherwise you'll end up selling off in one area and you won't be able to recover the way, like if your portfolio was 100% ball and gainer, you know, you could dance in and out of some of these problems. I don't think we've figured it quite out today.
Well, the other aspect that's going to creep into all of this relates to that first question I asked. You know, are any of these considered private endowments that have to take the 5% annual distribution? Because we know with the Fifth Third accounts, they are considered private endowments. We do have to take the 5%. So that's already going to skew it if we're taking 5% from them. And, you know, now to make our total nut that the park board says we're going to draw down this year, it really means we're only drawing down 1 or 2% from ball and gainer, because we had to take so much from the other.
Yeah, and that's traditionally kind of, you look at this past year, what occurred is we knew we had to do a draw of 5% from the Fifth Third accounts as well as one of the Fleshman accounts. And because of that, that allowed us to draw down or decrease the draw from like the Miles Edwards, as well as the Drabner, Geyer Fund, the other Fleshman Fund. So we already kind of had that in place. I do want to say, I think it is a good exercise to look at. We also have to keep in mind that the $4,192,000 there, that is actually investments that we can liquidate and spend right away with the park board. And that doesn't include the 2.5 million we still have it in the money market account that's not shown on here either.
You shouldn't be telling me this if I'm going back on city council, Craig.
And we're doing a good job this year. Actually, you're going to see some money move away from that money market account and into projects. So an ordinance just passed. It's going to pass tomorrow or today. Today's Wednesday. Yeah, should have passed today.
You know, Craig, what you said kind of implies that our policies protect us from hurting ourselves a great deal, don't they? I mean, we don't maybe have to think as hard as we've been thinking the last 10 minutes, because a lot of the IPS is gonna take care of itself, because we should be doing kind of what you described. We should be dipping into those buckets. We should be only taking a modest distribution from other areas, and we're kind of doing it already.
And the IPS is pretty flexible for those investment managers. So if we would go down that route of wanting them to increase their equities, that's something we would have to adjust on the IPS and being a little more straightforward with them, because I believe there is a range up to, or remember the IPS, up to 80% for US Bank and PNC. I can pull it up real quick, but we gave them pretty good flexibility there.
And there may be some daylight between IPS flexibility and expectation flexibility. So, you know, they likely, investment managers lose their jobs when they get to the outer edges of, you know, they don't want to touch the guardrails. So if we want them to move that way, we may need to sort of clarify for them the our approval of them doing that in advance of them doing it.
And
Sometimes
Craig,
you have to give them that. You have to give them that green light that they're allowed to go higher. Because I'm looking at our IPS right now, and it's up to 90%.
Wow. Okay.
And Craig, I guess, you know, if this is my last meeting, one of the things that I would leave you with is, when we do have a project coming up, even if we if we can keep the money in here for as long as we can before we go to spend it through the city, I think keeping it in here, we're going to get a better return than if we, you know, we've now created the project for, you know, Ezra Charles Park platform. And we know it's going to cost $3 million of commissioner's fund. Rather than on day one moving that $3 million over there, wait until the contracts are let. They know we've got the money. Wait until they're getting ready to make the draw, and then move the money over there. Rather, because we really haven't seen them investing park money very well, if at all. You know, if they're either doing a sweep with the interest collection, or, you know, on some of the long time money, they've let us accrue interest on it, but it's not been significant interest like we have here.
That's exactly correct. It's definitely something you want to provide to the city and the program towards the last second, just getting the money in there, not pulling out too soon, because you do not want to have money sitting in a program or project. They call them programs in our system for a year or 2 years, because it will sit there and generate minimal income.
And people like me that don't have the inside information will be sitting there on council saying, well, these guys already have all this money sitting on account. They don't need a capital budget this year.
Yep. Okay. We'll move on. Any additional items around the third quarter performance allocation? And on there as well as just the benchmarks that came from Vanguard. The last item is usually the item that Jim provides, is discuss outstanding items of park projects. Right now, if you haven't heard, the Lido Park project litigation is over, and that project is moving forward. So that is definitely a great thing. We're actually going to go out and we're going to do some design changes. It sounds like just get a bocce court, and we have to move the tree. So one tree was saved, and it's going to be moved within Lido Park. So right now we're going through the design phase. Then we'll go through the procurement, and we're hoping to break ground in April of 2022. Right now there's discussions occurring, obviously, with lot 28. That's primarily being handled by Hamilton County with insight from the park board. And trying to think of any other large projects that are occurring at this time.
Boat dock.
Oh, the boat dock presentation. There will be a special meeting. Thank you, Kevin. There will be a special meeting on the November the 8th for the individuals, the firms, to go ahead and present to the commissioners for who could potentially be awarded the boat dock. So we can't wait. And that's something I hope they have out there next summer. So boaters can go ahead and tie up and enjoy the park. Then for the capital budget, the capital budget project process will start in November. So by the time we meet next time, the fiscal year 23 capital budget should be approved, and we may be looking at some commissioner fund dollars there as well. So we'll see what those balances are and how we can help draw down that account a little bit more.
One of the things, again, Craig, that I would suggest relative to that capital budget is going in there armed with our outside third-party report that says these are all the things that are in poor condition. So don't just give us your normal $2 million with $1 million of it being eaten up in salaries.
That's exactly. It's shown them that, as well as providing them exactly that report you're talking about, the projects that weren't funded in 2022. This year that we now have to push over to 2023 on top of what we already budgeted for 2023. And definitely that's one thing we did show last year too, is showing them the pictures of the facilities, of the infrastructure that needs to be repaired. And that's definitely something we'll be looking at. Okay. Next meeting, would we like to have another investment manager? About every meeting we've been pulling in investment managers. The next investment manager would be either, I believe it's US Bank's turn or PNC, or do we want to go without an investment manager in next meeting? I think probably the best time to meet would be towards the end of January, going into February. This way we have fourth quarter results. We don't have anything really pressing from a distribution standpoint that we need from the endowments. Is everybody comfortable if we look towards January and February?
Yeah, I think, and even the year-end statements may be a little bit later than a normal month or quarter, so
Yeah.
February would probably work. I think PNC was the last ones to present in front of us, weren't they, Craig? Or
We had Ball and Gainer, the last meeting in July. Was it July? July was Fifth Third Bank.
oh, okay,
And then
yeah.
I'm trying to think of who was before that. It was either US, I think it was it was PNC. It was PNC because we had them come back and review it. So the next up would be US Bank.
I think you're right.
So I have US Bank present. And I do have a question, because what I could do if we really enjoyed that format from Ball and Gainer, I don't know if the other investment managers would mind, but I could remove a lot of the information from Ball and Gainer and see if they can provide similar statistics with their presentation.
I thought it was useful and efficient, and I think it's a large enough portfolio with each of the different managers that it's a reasonable request. I don't have to be like an exact mimic of style, but that level of, particularly some of the quant stuff around risk, where the risk fits in, I think is very helpful. And I'd want to redact it, although I guess it's probably public. It's public info, but they're not going to dig that hard. But I just, as a courtesy, I think I'd redact it somewhat, but say this was a format that the committee found useful. To the extent you're able to mimic that may streamline the review that way. The other thing I was going to suggest, if we want to, and I don't know that we necessarily want to, but if we wanted to, at this upcoming or the one after that meeting, at some point, have more of a strategic discussion about what we want to do with this information. And maybe we want to write another whole cycle of review, but kind of the conversation at the sidebar we sort of had about what do we do with that and how do we actualize that. I'm okay skipping a quarter of manager review to have that conversation. And it's a little bit of a, I guess it would be what would we recommend to the commissioners as a set of steps around that. But I think it's at least, it's not a bad conversation for us to have. Again, I'm not advocating that it has to be the next time around, but sometime I'd like to say, I don't want to just review it because we always review it. I want to review it because we act upon the findings of those reviews.
I agree.
I think that's a good idea. I don't think this next meeting is probably too early to do that. We have had several meetings over the last couple of years where we didn't have a presenter. Now we've had 4 in a row. We know who these guys are, and especially now that PNC is kind of back on track. I think that's a good idea, John. Maybe our next meeting we don't need a guest appearance.
Yeah, and I would say that, from where we started to where we are now is light years ahead. We now have this data, John, as you were talking about. That was really one of the reasons that I got involved with Park Board, was there was such a lack of transparency between city and Park Board that I really wanted to jump in here to make sure that we were operating in the way that we're supposed to operate as a governmental entity with these private endowments that don't usually exist in public entities. And I think I, for one, am very comfortable with everything we've done with hiring the outside trust counsel, with getting these reports with Craig doing them. We've eliminated Mercer. I mean, we've done a heck of a lot with that. It now almost becomes, what's the next step, as John was saying? How, do we take all of this information we got and somehow either say, hey, we're doing everything right and we're maximizing what we can do, or if we do A, B, and C, here's the risk benefit analysis. Park board, you tell us what you want to do, but we're providing you with this information that you may be able to get a better return overall if you do it this way.
I like it.
So we'll schedule that meeting for February, and I'll put it on the calendars. I know that's pretty far out, so I'll probably initially send an invite to see who's available. And did we want to have it towards the beginning or the end of the month? As long as it's not to before the third Thursday of the month, I'm all right.
Yeah. I think, if our approach is going to be kind of look back on full year to date stuff, we can meet early in February, and it's not that we would need the January statements or something, probably. But I mean, I think anytime that month is going to be fine, Craig. Anytime that first quarter is probably fine.
Yeah, I'll probably target earlier in the month, because towards the end of the month, that's when we start gearing up for budget.
Yeah,
Sure.
that feels good.
Well, thank you, everybody. Is there anything else we'd like to discuss?
Vote for Flynn.
Good luck, Kevin.
Good luck to you.
Good luck.
I'm not sure what that means. I have mixed emotions about, do I want to win, or?
That's why I refrained from specificity. Good luck.
I hope you get the outcome you want.
Yeah, me too. I don't know what that is, but no, there's a lot of good folks running. There's a lot of folks that have no clue how the city actually runs. We've had very few forums this time, but we've had a few where people are asking questions, and of course I'll go into the deep dive with data, and I'll just see other candidates' eyes like get really wide, like, how does he know those things?
Yeah.
And I've had other candidates afterwards like come up to me and say, well, I'm definitely voting for you because you seem to know what's going on down there. Oh, guys, don't say that out loud too much, or you're not going to get any votes. Fake it till you can make it.
I think you're in good shape.
We'll see.
Well, everybody have a great day.
I lost a vote. Neyer's not in the city anymore.
Yeah.
I doubled the number of Democrats in Claremont County when I moved.
I think you're right.
Yeah.
Now, did Scott buy your house, John? Is that what I saw? Provancher?
No,
No.
it was a guy named Richard Craig. He's a beer distributor from Southern Indiana. He tried to buy it 9 years ago when we bought it. And he note in the mailbox kind of situation. And,
Wow.
the kind of, and I don't think YouTube is probably following this, so I don't particularly care. But I just put out a number that I was very comfortable with. And he said, for that number, I need some furniture. Dude, for that number, you can have my cars. Yeah. So I hope he's enjoying it and doing well. We're certainly enjoying being in a more bucolic rural setting. So
That's awesome.
That's good.
That's great.
See, I'm in Mount Airy. I get the best of both worlds. I get that.
Absolutely.
Betting and
if we get tired of this, maybe we'll look west.
I think it's probably quieter where John is, Kevin.
yeah, but I've got Mount Airy Forest on the other side of the street from me.
Yep.
I've got 2.5 acres behind my house, and it's 7 minutes for me to get down to City Hall. It's like
Not bad.
We were out back the other day sitting on the porch, and a whole family of turkeys, a mama with like 10 babies came along, and the deer are out front eating our acorns right now.
Yeah.
The only scary part is when we hear the pack of coyotes at night. And I'm sure, John, out in Claremont County, if you weren't hearing them in Clifton, you're hearing them now.
Well, we actually lost a little dog to coyotes in Clifton 5 years ago, and I'm not much of a shooter, but should we see coyotes, I have the ability to correct that situation now. So
they are all over the place here. There was one walking on the street. Somebody in the neighborhood took a picture of it and shared it in the middle of the day.
Oh, wow.
I'll have to help
They're
you.
getting bolder and bolder.
That they are. So,
All right, guys.
During the meeting, that would normally be Jim's gig. Do we need to?
Do we need a
Meeting
motion?
adjourned.
Meeting
Yeah.
adjourned.
Seeing
At
no
4:20.
objections, unless there are objections to.
No objections.